What if I told you that a single post on social media could ignite a global economic firestorm, threatening to wipe billions from a nation's economy in the blink of an eye? This isn't a Hollywood thriller. This is the reality of 21st century geopolitics. And right now, India is in the eye of the storm. Welcome to Bankers Bootcamp, your front row seat to the real world of finance and geopolitics. I'm your host, and on this channel, we don't just provide you the ways to enter into investment banking or decoding our financial concepts, but we also make you interview ready by talking on key financials, ongoing situations. We dissect it, we analyze it, and we give it to you the market instincts to understand the forces shaping our world. In our very first episode of this brand new series, GRWM for Interviews, we are tackling a massive development. Donald Trump's decision in late July 2025 to slap a staggering 25% on all Indian goods with an added unspecified penalty for India's ties with Russia. So what does this mean for you, for India, and for the world? Over the next 10 minutes, we are going to break it all down. We'll look at the impact on the Indian economy, the BRICS nations, and even the US itself. We will explore how this trade war is redrawing the map of global power, and we'll deep dive into what this means for the Indian stock market, including the movements of FIIs, DIIs, and FDIs. We'll also uncover two crucial geopolitical factors you won't hear about in the mainstream media. So buckle up, this is Bankers Bootcamp. Let's get straight to the point. A 25% tariff is a massive blow. Economists are predicting this could slash India's GDP growth by 20 to 40 basis points, potentially pushing it below 6%. To put that into perspective, we are talking about a significant slowdown for one of the world's fastest growing economies. The sector at ground zero of this economic earthquake are some of the India's most vital: gems and jewelry, pharmaceuticals, textiles, and electronics. These are labor-intensive industries. So we are not just talking about numbers on a spreadsheet. We are talking about the livelihoods of thousands of people. The tariff could cost India up to $30 billion in export earnings, a shock to our supply chains and employment. But here's the twist. Some analysts believe the impact might be cushioned. Why? Because India's rivals are also facing higher tariffs, and India's economy is largely driven by strong domestic consumption, which gives it a buffer that many export-heavy economies lack. This isn't just an attack on India, it's a shot across the bow of the entire BRICS bloc: Brazil, Russia, India, China, and South Africa. Trump's tariffs have targeted China, India, and Brazil specifically. This is part of a broader strategy to counter the growing influence of these emerging economies and their efforts towards de-dollarization. The impact on BRICS nations could be severe. China, the world's factory, relies heavily on the US as its largest export market. India's IT and pharma sectors have a huge stake in the US market, and Brazil's agriculture economy could take a major hit. But here's where it gets interesting. This pressure from the US could actually push the BRICS nations closer together. Since 2021, trade within the BRICS bloc has already surged by 40%. The current trade war could accelerate this trend, strengthening their resolve to trade in their own currencies and reduce their dependence on the US dollar. A trade war is a double-edged sword, and the US is not immune to the blowback. The tariffs on Indian and other goods will lead to higher prices for American consumers on everything, from electronics to clothing. We are talking about a direct hit to the wallets of the ordinary Americans, which could fuel inflation. The economic models paint a grim picture. The Tax Foundation estimates that Trump's previous trade war tariffs have already reduced long-run US GDP by 0.2% and cost the country 142,000 jobs. The current escalation is expected to make things worse, with projections of a 1% drop in GDP and a 1.4% decline in real wages in the US by 2028. What we are witnessing is a fundamental shift in the global politics. We are moving from an era where geopolitics was driven by military alliances, where economic security is paramount. Tariffs are no longer just economic tools. They are the weapons in a new kind of warfare. This trade war is forcing a massive reorganization of global supply chains. Companies are desperately looking for alternatives to China, a strategy known as China Plus One. Countries like Vietnam, Mexico, and even India are emerging as new manufacturing hubs. But this shift also brings logistical nightmares and rising costs. The world is becoming more fragmented, with new trade blocs forming along geopolitical lines. We are seeing a decoupling between Western economies and the China-Russia axis. However, supply chains are resilient. Instead of being severed, they are often rerouted through third countries, adding new layers of complexity to the global trade. So what does all this mean for Indian stock market? In one word, volatility. You saw it live. Markets tanked on Trump's announcement. Nifty 50 dropped to 24,666 while BSE Sensex dropped by 600 points on July 31st. The announcement of these tariffs sent shockwaves through the Indian stock market. We have seen significant withdrawals of foreign portfolio investment (FPI) with debt outflows of 15,194 crores and a staggering rupees 28,919 crore pulled out of India in the period following the announcement. In January and February of 2025, FPIs withdrew a massive rupees 78,027 crores and rupees 34,574 crores respectively. This is the classic behavior of foreign institutional investors, FIIs. They are often the first to exit in the times of uncertainty. But here's the other side of the coin. Domestic institutional investors, DIIs. During these periods of foreign capital flight, our domestic institutions like mutual funds and insurance companies have stepped in, investing heavily and providing a much needed cushion to the market. Since late 2024, FIIs, foreign institutional investors, have sold over 1.24 lakh crores in Indian equity year to date, spooked by our global volatility and pulling money into safer shores or even back into China. Meanwhile, DIIs, domestic institutional investors, have been net buyers, stepping in to cushion the fall, with inflows topping rupees 1.29 lakh crores. The big question now is about foreign direct investment, FDI. FDI is the long-term stable investment that India needs to build its manufacturing capacity. While the tariffs might make some investors nervous, the China Plus One trend could actually boost FDI in the long run as companies look to diversify their manufacturing base away from China. Now let's look at the two critical geopolitical factors that are often overlooked in the headlines. First, the Pakistan gambit. Hours after announcing the tariffs on India, Trump revealed a new deal for the US company to develop Pakistan's oil reserves. He even cheekily added, maybe they'll be selling oil to India someday. This is a classic geopolitical move using a regional rival to apply pressure and create leverage. It's a clear signal to India that the US is willing to play hardball. Second, the Russia connection. The penalty Trump mentioned is directly linked to India's purchase of Russian oil and military equipment. India's oil imports from Russia have skyrocketed in recent years. While this has been economically beneficial for India, it has created a major friction point with the US and its allies. This puts India in a tough spot, forcing a delicate balancing act between strategic partnership with the US and its long-standing relationship with Russia. So what's the bankers' bootcamp bottom line? India is at an inflection point. The 25% US tariff is a body blow to shrinking GDP, threatening millions of jobs and undercutting dreams of becoming the world's next factory. BRICS is under siege. Member nations, including India, face pressure to either toe the US line or risk further trade isolation. The US is playing with the fire. While it may reap some tax revenue and short-term trade balance wins, higher prices and a fragmented global order a longer-term risk. Markets are jittery, FIIs cautious. The road ahead for investment is bumpy, but resilient DIIs and India's domestic strength remain a silver lining. World geopolitics is changing fast. This trade war isn't just America versus India. It's the dawn of a fractured order, a multipolar world, and new rules for everyone. For India, this is a moment of truth. It's a test of our economic resilience, our manufacturing ambitions, and our ability to navigate the treacherous waters of the global geopolitics. The path forward will be challenging, but it also presents an opportunity for India to emerge stronger and more self-resilient on the world stage. What do you think? Is this trade war a disaster for India or it's a blessing in disguise? Let me know your thoughts in the comments below. And if you want to stay ahead of the curve on the biggest issues in finance and geopolitics, make sure you subscribe to Bankers Bootcamp. We are here to give you the knowledge and the insights you need to thrive in this ever-changing world. Thanks for watching, and I'll see you in the next video.